Hey, welcome back to Hoisting Income. This is the first week of April 2025, and then you see a lot of red in the markets. If you see the S&P 500, it's almost down 6%. And you can see, similar trend in the other indices, Dow Jones, Nasdaq, Russell, etc. Uh, on Friday, the last, trading day, like April 4th, like you can see a 6% fall. And if I look at it, 5 days ago, like it's been a fall of 8%. Like if you look at it 1 month ago, it's been like down by 13%. Like it's a big fall. And for this year, currently year to date, from January 1st, like we have seen like almost like 14% fall in the markets, 13.73 to be precise. Okay, so here this video is not about just the index. Like we are going to talk about two exchange traded funds, HDIF and HRIF. These are from Harvest portfolios. And the reason why I'm going to cover this is because in these times it is important to have a diversified basket which can provide you not only decent returns and a dividend yield, but also some kind of stability. And this is not a magic solution, because this is going to be also affected by the markets, but you can be rest assured that you have a diversified basket to look into. So having said that, let me quickly go take you through the HDIF, which is the Harvest Diversified Income Fund, which pays a monthly dividend. Pretty interesting fund. It is plain and simple to look at, but it's a lot of interesting features in the fund. I'll first take you through the HDIF, and then I'll compare it with the other fund, HRIF, which is the you know, Harvest Diversified Equity Fund without the leverage. HRIF is without leverage, but HDIF is with leverage. Both are from the same fund house, which is Harvest ETFs, and they have similar portfolio, similar design. But one has leverage, which is the HDIF, which comes with the 25% leverage, and this is built to deliver the consistent monthly income. And the ETF holds a pro portfolio of Harvest Equity Income ETFs across multiple sectors, across different areas of the market. Let me quickly show you the basic features of the fund, the basic information. The ticker is HDIF, and this would be more relevant for audience in Canada, because this is a fund which is listed on the Toronto Stock Exchange, and it is a Canadian hedged fund. The price is close to $7.41. So ticket size is pretty low. Anybody can start investing in this, and they have like $367 million of assets. A pretty decent fund, and they have yield of about 12%, because they use the covered call strategy. They generate regular income. So basically, the strategy is pretty simple. The ETF is designed to provide a consistent monthly stream with opportunity for growth. So basically, what they do is they have a portfolio which is composed of different funds from the same fund house. I'll show you the portfolio to give you the idea. Like you have the Harvest brand leaders, Harvest equity income ETF, global utilities, healthcare ETF, and so on and so forth. Like it is equally spread across most of the Harvest ETF. Some of them have a higher weighting, some of them have a slightly lower weighting. For example, travel and leisure has a slightly lower weighting, and REIT has a lower weighting here, and industrial leaders is just 6%, and there is a 25% leverage. So the goal of the fund is to actually offer a steady monthly distribution, and they use the active covered call strategy on 33% of the securities, which means about one third of the portfolio is used for covered call writing, which generates regular income. The remaining two-thirds of the portfolio is just like held in the account, and you get the full benefit of appreciation. And it is linked to the market. Like if the prices go up, your NAV goes up, and if the portfolio values go down, your NAV goes down. It's linked to the market. So on 65% or two-thirds of the portfolio, you are getting the benefit of appreciation, Whereas on 33%, your upside is capped. It's not like the upside doesn't exist, it is capped at a certain level. And you are getting regular dividends because of the covered call writing. So according to the fund, like the benefits of investing in HDIF is it's a one-stop diversified, monthly income solution, and they have leading large cap companies diversified across sectors, and they also study the long-term powerful trends and consistent yields and so on. And it says zero management fee, but the underlying ETFs have a fee. I'll quickly show you one of them just to give you the idea. For example, let's take the first one, brand leaders plus income. So when I look at this fund, this is also a covered call fund, and it has a $8.89 NAV, and the ticker symbol is HBF. Yield is 8.73. So there are underlying ETFs which are also covered call ETFs within the same fund, and within the same fund family, and they have 20 large companies. Let's see what are those 20 large companies. I'm just scrolling down. Okay, let me click on the portfolio. Okay, you can see these names here, all the blue chip names: Coca-Cola, Shell, McDonald's, Procter and Gamble, Cisco, PepsiCo. All these are very familiar names, are very large blue chip names, not a small firms or small cap stocks. These are all blue chip large cap stocks. So it's very good on the safety front. So we have this fund, and I'll show you the other fund just for an example. Um, they have this Canadian equity income leaders. The first one we saw were pretty much global companies based in the US. This one is going to be little more tilted on the Canadian side. Look at the portfolio. Then you can see Great West Life Company, Alta Gas, Canadian Utilities. Again, these are some of the largest blue chip companies in the energy or real estate space. And you can also see some other retail players like Canadian Tire and so on. So you have all these big players like which are familiar names in the Canadian market. So we are talking about all the blue chip companies. So it's a safe portfolio. The underlying portfolio has to be same. Like the covered call strategy works, but if the underlying portfolio is not good, the covered call strategy may still not help you get those returns or the capital appreciation. In this case, all the funds we have here have good blue chip companies. And if we look at the fees, like for example, let me open the first one again and look at the fee of the fund just to get an idea how much they are charging. Okay, management fee is 0.75. So most of the fund have like 0.75, 0.65 in that range. So you will be, you know, roughly, incurring this cost in terms of the management fee or expense ratio. And so that would be the cost of investing in the fund. It's not that expensive because you have the covered call strategy on different funds and packaged into one uh, ETF. So you have various sectors, various things packaged into one. You even have something like travel and leisure companies, you have real estate companies, REITs, and you have US banks, you have healthcare leaders, and a lot of interesting blue chip companies packaged into one. And if you look at the sector breakup, it's financials predominantly, and information technology, healthcare, followed by utilities and consumer discretionary, and various other sectors. It's a pretty fairly diversified portfolio. So this is about the HDIF. The main feature of this fund is it is a covered call covered call rating fund. Plus, it has a mix of various sectors, various things packaged into one. It's an all-in-one fund. It's not like any other typical fund that is based on the Nasdaq or S&P. It has a little bit of tech, a little bit of healthcare, a little bit of utilities. So it's a kind of broadly diversified. So you have a broad diversification advantage, and so due to that, this is pretty unique, like compared to the other funds, and you would like to have this fund across all market conditions because it's completely diversified. Even if everything falls apart, like what happened in the last week, uh, we still like to have this fund in the portfolio. And by the way, this is not any sponsored video or anything. Like, I'm just sharing my views, and I have exposure to HDIF in one of my portfolios. Just that's for disclosure. But if you find it interesting, you can use this opportunity to buy if you like the portfolio or if you like the strategy. Okay, now let's do a quick comparison with the other fund, which is in the same category. We were talking about HDIF so far. Now we will shift focus to the other fund, which is HRIF, which is exactly similar with a slight difference. I will open this one, HRIF, Harvest Diversified Equity Income ETF. And this one, you can see the description also is similar. It offers consistent income from a portfolio of established harvest ETFs. It delivers exposure to a diversified set of large companies, and also it has an active and flexible covered call strategy applied to its underlying ETFs without the use of leverage. The difference between the previous fund and this fund is just the leverage, which is absent in the case of HRIF. HRIF is unleveraged. So basically, there's no leverage in this fund. So if you're not comfortable with leverage, you can go for this fund. What is the pros and cons? Okay, if you have leverage, when you have good returns from the market, let's say you make 10% returns, the leverage is going to give you the ability to make a little more. For example, you might make something like 12% when the index is giving you like 10% returns. Whereas when the market falls, like when you have a downside, the let's say the index falls by 10%, then the leverage will increase your negative returns too, so it will go down by 12%, for example. This is just a hypothetical example. But a non-leveraged ETF will not have that volatility. So if you are not comfortable with the high volatility with leveraged funds, you can look at HRIF. The other difference is HRIF was launched in 2023, I think, and HDIF was an older fund which was launched in the year 2022. So that's a difference. Uh, so they were launched at different points of time. HRIF came later on because there was a need for a safer monthly income option, especially for people who are looking at regular income and they want safety. They are more conservative. For example, it could be retirees or people who are looking at getting income on a steady basis, consistent basis, without too much of volatility in the price. And this was a solution that Harvest provided. So it's the same concept, not much of a difference. The only difference you will see is the in the portfolio there will be no leverage. If you look at the portfolio, it is also similar. The numbers would be slightly different because you don't have the leverage here. You don't in the cash side, you don't have any loans. So basically there's a slight difference because of that in the weights. And if you look at the distributions, it's 9% in the case of HRIF. In the case of HDIF, it is 12%. Let me do a comparison side by side here to show you. Okay, we have both here, HDIF and HRIF, and you can see the market price is different for both because they were launched at different times, different prices. So 741 and this is 1470 HRIF, and assets under management is low in the case of HRIF, just 18 million. HDIF is pretty established, 367 million, and both are active style, both are similar. Yield is different. You can see the yield is 9% for HRIF, whereas 12% for HDIF, which has leverage. So obviously higher yield and similar holdings. The underlying ETFs are same. And let's look at the performance. When you look at the performance, you'll feel a slight difference between the two. So when I look at the 1 year performance, the HDIF realized about close to 9%, 8.86. And when I look at HRIF, it's 8.12, slightly lower. And it's not surprising because obviously with lesser amount of leverage, you get a slightly lower return on a 1 year basis. That's not fully surprising here. And let me adjust the screen a little bit to show you the 1 year performance of HRIF. So in 1 year, you made percent, and in 2024, HRIF made 16% close to. Let me see on the other side how much it is on the here it is 18 or close to 19%. So there is a advantage in terms of leverage when you have a higher return on the positive side. On the you can also see here like in 2023 they made 8% on HRIF. On the left side HDIF they made 12%. So leverage actually gives you that enhanced ability to boost your returns. Whereas in the case of HRIF without leverage you are getting slightly lower returns. At the same time you will be making less risk. And remember that when you are making high returns on the positive side, on the negative side too, you might face more negative returns, especially on the capital front, like when the price appreciates more or less. So that will give you the difference between the two. Uh, when I look at the here the cumulative market price which Harvest publishes, it's pretty interesting. I'll show you one by one. From the beginning to now, if I look at it, like HDIF started at around 985. Let's assume $10 for simplicity. They started at that level. And when I look at here, like they are showing the orange one as marketplace price plus distribution, whereas the blue one is just the market price. On a market price basis, the fund has actually declined compared to the starting price. But when you look at the distributions plus the market price, you are on the positive side. You're about $10.87, close to $11. Like you started at $10. And these funds are designed for income, not for appreciation. Uh, but when the markets go up, like in the last few months, end of 2024, I can see that the orange line is much above, and there is a spike here in the market price. Market price went to 923. So at that time, market price plus distributions is above, you know, $11.5, which is pretty attractive at that point. So this is a good point, probably for someone who is looking for a bit of capital appreciation plus the distributions. And if someone is like in need of cash or something, probably this is a point where they can sell. I mean, this is not a recommendation, but these are some things that I have observed like over the years. And there have been times in 2023, the fund fell down, like it fell almost close to $7 or 696 to be precise. This is again a point where you could have bought more. It's a good buying opportunity here. But of course, nobody knows the timing. There's no way to perfectly say what's a good time. But it's a good idea to look at these points. If you feel that it's low priced, you can buy more to earn more dividends in the future. So that's about the HDIF. Let me look at the HRIF, and this will actually give you the idea how it performed. When I look at HRIF, there is a much better performance in the price front or the NAV front. The net asset value has been pretty steady. So it started close to 1469, 1470, let's say $15 just for the simplicity. And now it launched in 2023 May. So 2 years later, roughly 2 years later, at the end of March 2025, you are sitting close to $16, 1593, close to $16. So the net asset value has appreciated, you know, in this period. Whereas in the previous one, since they launched, the net asset value has come down. Even though that fund HDIF was a little older, it still, lagged on the market price front. So this is another observation that I found. So someone who is interested in stability of NAV could probably look at HRIF rather than HDIF. I mean, this is just my view. And when you look at the distributions are pretty decent as well. Like with distribution of about $3 or something in this period, you have your total market price plus distribution is about $18.32, and you invested $15 in in 2023. Over 2 years, you have made that kind of return, which is decent. I don't know the exact percentage here. It is a decent amount of return. When I look at the returns here, like 2023, it was 8%. 2024, you can see that it's 16%. So this can move up and down. Like it's not going to be a steady, graph moving upwards. You will see a little bit of volatility, but you will see the steady amount of dividends coming in every month. And the good news here is these dividends are sustainable because they are only writing calls on 33% of the portfolio. And if the markets go up on a steady basis, the funds are going to underperform a little bit because two-thirds of the portfolio is linked to the market appreciation. So you're getting good amount of appreciation plus you're getting the yields. Yes, if the markets are going down, yeah, you will get yields, but you may suffer on the capital appreciation front. So that's the drawback you have with these funds. And when there is a leverage and it's going down, it's going to pull down the NAV as well. So that is one of the reasons why the HDIF has seen a decline in the NAV, and then HRIF is able to hold a steady amount of NAV. So if you are not comfortable with seeing that erosion, probably you might want to opt for HRIF. Both are equally good. Like, it depends on if you are a long-term investor and you are younger and you have a longer period and you are comfortable with volatility. HDIF with the one with leverage is a good option. However, if you are conservative or you don't like the volatility, you want a stability of net asset value, HRIF is a great option. I hope you like this comparison video of these two funds. And it's interesting to see that the non-leveraged fund HRIF has actually performed well on the price front or the net asset value front. That's an interesting finding. But we will keep track of this and see how they perform in the future years. I hope you like this video on comparison of two all-in-one ETFs. And if you like the channel, please subscribe. And if you have any questions, please drop them below. Thank you. Happy investing. Take care.